Okay, well, turning to the economy, we will start with inflation, which has been a key theme of 2023, but hopefully loses its grip on headlines in the new year. Headline CPI cooled to 3.1% in November, which is down 10 basis points from the month before, as inflation continues its downward trend. Stripping out the volatile food and energy components, core inflation held steady at a 4% increase year over year. And that increase has been driven almost entirely by services and to a large degree by shelter prices specifically within that broader services category. As the chart on the right here indicates, core goods prices, which drove the initial bout of inflation in 2021 and early 2022, have stabilized. The sector's annual inflation rate has been flat, right around 0% for the last several months. So both inflation, the inflation rate, and prices, in fact, flat over the last year for a couple months now. In contrast to that development, core services inflation has remained elevated, with prices up 5.5% over the last year. Shelter prices are up by an even larger margin of 6.5%, although that does represent some moderation from shelter's peak inflation rate of 8.2% back in March of this year. That rate's likely to continue moderating, but it has been fairly stubborn, cooling a little bit more slowly than many economists had anticipated earlier. So despite this moderation that we've seen over the course of the year, the Federal Reserve said last week that it's still premature to declare victory on inflation, so we'll keep watching these releases with a sharp eye for now. Our next slide shows the other big news out of the Fed's meeting last week, which was that the FOMC decided to hold rates steady again at the 5.25 to 5.5% range that it initially set back in July. Fed officials sounded a much less hawkish note at the meeting, and Chairman Powell indicated that risks of overdoing and underdoing monetary tightening are more balanced now than they have been. This suggests that the Fed may begin shifting its focus to more balanced considerations of its dual-sided mandate for both full employment and stable prices. The Fed penciled in 3 rate cuts for 2024, which would see the Fed funds rate end next year at 4.5 to 4.75%. Financial markets, however, continue to bet on more and earlier rate cuts. Futures pricing currently implies 6 rate cuts in 2024, so over double what the Fed penciled in, with over 80% odds that the first cut comes as soon as March of next year. Now, here at RCLCO Fund Advisors, we view this as overly optimistic, particularly given the Fed's propensity over the last several years to make policy pivots pretty slowly. So we'll briefly touch on our house view later in the webinar, but as a sneak peek, we do expect rate cuts to begin in Q3 of next year, so a bit later than the March beginning date that markets are pricing in right now. Regardless of when rate cuts do end up beginning, it does look as though we are at the end of the Fed's most aggressive rate hiking regime since the early 1980s. The chart to the right here gives some historical context to just how fast the current hiking cycle has been. So turning to the next slide, the optimistic news from the CPI report and from the FOMC quickly trickled into the bond markets, sending medium and long-term US Treasury yields down. The 10-year yield fell below 4% late last week for the first time since July, and it's remained sub 4% since then. This represents a decline of 50 basis points from a month ago and over 100 basis points from its mid-October peak when it touched 5% briefly. The 2-year yield similarly declined, down approximately 80 basis points from its most recent high, which was during that same time in mid-October. Short-term yields have been less affected and remain highly elevated. Consequently, the US Treasury yield curve is still strongly inverted, as the chart on the right here shows. Medium and long-term yields are roughly in line with their levels from year-end of 2022, but short-term yields are significantly higher, as you can see by comparing the dashed dark blue line to the orange line on the right-hand chart, which shows how much higher short-term yields still are. So for an example of this, the 3-month yield was at 5.4% late last week, compared to 4.4% at the beginning of the year. So 100 basis points up still over the course of 2023. So overall, loosening of financial conditions remains a potential risk to the Fed's outlook and could keep the economy running hotter than desired. However, Chairman Powell didn't express particular concern about this last week. He was fairly benign about it. And in the near term, yields are likely to experience continued volatility as markets attempt to price in new data and as the economic landscape for 2024 comes into view.